Every Monday to Friday, this is Peter Lewis's Money Talk.
Money Talk.
Good morning, this is Peter Lewis. A warm welcome to my podcast Money Talk for the final day of the week, Friday the 9th of June. This podcast is now consistently one of the top 10 most listened to finance podcasts in Hong Kong on Apple Podcasts. Thank you so much for listening and keeping us at the top of the rankings. We're also on Google Podcasts and Spotify. And if you want to get in touch, please go to my website, peterlewismoneytalk.substack.com. You'll find my daily newsletter there with a lot more business and finance information. This podcast is sponsored by Surfing Group, which is headquartered in Singapore and offers online financial services to 30 million customers across 10 countries. In today's business and finance headlines, China's 6 biggest state banks cut deposit rates on Thursday in a bid to boost the economy. The changes, which came into effect yesterday, will also see 3-year and 5-year deposit rates drop by 15 basis points to 2.45% and 2.5% respectively. It's the second time in less than a year that Chinese authorities have asked the nation's biggest banks to lower their deposit rates. Japan's economy grew much faster than initially expected in the first quarter as corporate spending picked up on the back of robust earnings and private consumption also increased. The Japanese economy advanced 0.7% in the first quarter of 2023, compared with a flash reading of a 0.4% expansion. The Reserve Bank of India held its key repurchase rate at 6.5% yesterday for a second straight month. The latest move was in line with market forecasts amid easing inflation. India's annual inflation slowed to an 18-month low of 4.7% in April. That's within the RBI's 2 to 6% target range due to a slowdown in food prices. New downwardly revised figures from the Eurozone showed the economy shrank in the past 2 quarters, putting it in a technical recession. The Eurozone economy unexpectedly dropped 0.1% Q-on-Q in the first 3 months of 2023, compared to earlier estimates of a modest 0.1% rise. Figures for the final quarter of 2022 were also revised to show a 0.1% fall instead of a flat reading. The US Department of Labour reported that new applications for unemployment aid, which is a proxy for job cuts, climbed by a bigger than expected 261,000 last week, hitting their highest level since October 2021. It marks the third consecutive week of increases in the number of initial jobless claims, a sign that high interest rates are beginning to take a toll on the country's businesses. On today's programme, I'm joined by Francis Lun, the CEO of Securities, and Kenny Wen, Head of Investment Strategy at KGI Asia. With a view from Australia and New Zealand is Mike Gibbs-Harris, Director of MGH Asset Management in Wellington, New Zealand.
Peter Lewis's Money Talk.
On Wall Street, US shares rose Thursday ahead of key inflation data and the FOMC meeting next week. The S&P 500 traded 0.6% higher and ended the day at 4,294, its highest closing level of 2023. The index has risen 20% off its October 2022 low, entering a new technical bull market. The Dow gained 169 points, or 0.5%, to close at 33,834. The Nasdaq Composite climbed 1%, closing at 13,238. Investors returned to tech, with the NYSE FANG Plus index of 10 highly traded tech stocks rising over 2%, reversing its losses from the previous session. The Russell 2000 index of small-cap stocks, which has been showing strength in recent days, dipped 0.4% Thursday, but the index is up 7.5% in June. The CBOE Volatility Index, or VIX, fell to 13.65 Thursday, marking its lowest point since February 2020. The fresh unemployment data, pointing to a cooling economy, put pressure on Treasury yields, sending prices higher. According to CME Group's FedWatch tool, traders are pricing in a 74% chance of no change in interest rates at the Fed meeting next week. However, the odds of a rate hike by the end of July stand at 65%. The yield on the 2-year Treasury note fell 4 basis points to 4.51%. The yield on the 10-year note was down 8 basis points at 3.72%. The US dollar index fell to a 2-week low, and spot gold rose 1.5% as interest rate expectations fell. Hong Kong's Hang Seng reversed morning losses and rose 47 points, or 0.3%, to 19,299. The market recovered after the head of the National Financial Regulatory Administration said it will prompt banks to increase their credit supports to revive domestic demand. Futures markets are pointing to a small gain of around 35 points for the Hang Seng at the open this morning. Mainland Chinese markets also recovered from early losses. On the mainland, the Shanghai Composite closed with gains of 0.5% at 3,214. Shenzhen's tech-heavy Chinex gauge fell 1/3% to a new 3-year low, following a 1.6% fall on Wednesday. You can get more details on the latest market movements in my daily newsletter, which, just as a reminder, you'll find at peterlewismoneytalk.substack.com.
Every Monday to Friday, this is Peter Lewis's Money Talk. Peter Lewis's Money Talk.
Time to welcome our Friday morning guests. As always on a Friday, we have with us Francis Lun, who is the CEO of Securities. Morning, Francis.
Yeah, good morning.
And also joining us this morning for the final day of the week is Kenny Wen, Head of Investment Strategy at KGI Asia. Morning to you, Kenny.
Good morning.
China's 6 biggest state banks cut deposit rates on Thursday in a bid to boost the economy. They cut rates on 3-year and 5-year deposits by 15 basis points. The changes, which come into effect today, will also see 2-year deposit rates drop by 10 basis points. The banks are now offering 2.45% and 2.5% respectively on 3- and 5-year time deposits. So, Francis, is this going to make a difference?
Well, it makes a difference for actually for the bank's profits. I mean,
Yes.
Which is not quite the idea, though, is it?
For depositors, of course, they will get less. But of course, these deposit rates have always been very low to start with. But I think the important thing is really to improve the bottom line of the state banks, because they be under pressure for the bad loans to the real estate sector, and with improved profit, and they can make more loans and then maybe help boost the economy. The economy is not really doing very well, and unemployment is exceptionally high for the youth. People from 20 to 25. So I think the government must do something.
Yeah, I agree. First of all, I think totally agree with Francis, and I want to add more color. First of all, it is a matter of the market expectation that the government will use some policy to boost up the economy. Specifically for the cutting the interest rate, I will say there's 3 advantages. First of all, as I mentioned last time, there are a lot of excess saving in the banking system, because it's easy to understand, because if you worry about deflation, if you worry about the economic outlook will keep going down, then you will, even though you have cash, you will not spend it. You will just put it in a saving or banking account. So that's not good for the economy. So if we cutting the interest rate for saving, then maybe can force the saving to come out from the banking system, and you can use for investing on A shares, or you can buy properties or buy cars. So first of all, it's some kind of economic boost up measure. And also mentioned by Francis, the interest rate spread is very narrow. So if we can reduce the cost for of the saving, that is the expenses of the banking, then we'll improve their interest rate spread. Or put it another way, if they design to keep the interest rate spread, when the interest rate for saving is decreased, so the loan rate can be decreased. So there's a boost up for the loan. So I think from this one measures, there are 3 outcomes that should be positive, marginally positive to the economy, and also improve the possibility of the banking system.
But here's what I don't get. There's a reason why people on the mainland are increasing their savings and putting money aside. It's because, first of all, they're worried about their future. They're worried about their jobs.
Yes.
Secondly, they're worried that there may be another outbreak of COVID, and maybe they've got to pay for healthcare, and so, they're saving up for that as well. Maybe also they've got children who are one of those 1 in 5 who are unemployed, under 24. They've got to support them as well.
Yes.
So there's all these reasons, sort of structural reasons, as to why people are saving more. Is a 10 basis point, 15 basis point drop in deposit rates really going to go and make them spend that money instead?
I don't think so.
Yeah, I don't think that using one measures can boost up the economy, but at least it's a combination of measures. So cutting the deposit rate may be just one of them. We are looking forward for another. Put it this way, I think physical measures, monetary policy, as well as targeting specific sectors, for example, auto or property, some kind of measures we will launch out in coming 1 to 2 months. I think they will do it.
How bad are things then that we're sort of expecting all of these policy measures to try and boost things? Are things really that bad on the mainland?
Yeah, I think so, because the key thing is really the unemployment, and with 10 million graduates coming out every year. If you don't provide jobs for these people, there will be civil unrest. I think that is one thing that the Chinese government does not want to see, because in years past, the big techs have been hiring a lot of people, but they stopped hiring last year and this year. I think the thing is that you have to get the corporations to start hiring young people. Otherwise, there will be social unrest.
So what can they do then to focus on that? Because that seems to be one of the key issues, doesn't it? Dealing with this large number of unemployed young people under the age of 24. The government has suggested they should go back and work on the farms, but that doesn't seem to cut it, really, does it? They've got to surely come up with some concrete policies, not just talk, but some concrete policies to try and deal with that. What can they do?
I think there's a hurdle to launch a really large scale of stimulus policy, because if we focus on the Q1 GDP, there's talking about 4.5, and this year target is about 5%. So from the government point of view, the economy situation is not really so bad. But because we are investors, so if we focus on Hong Kong stock, if we focus on AGS, we always want to have more stimulus policy to boost up the investment market. Yes. So we are using different angle. If we try to use the government point of view, they may take a wait and see approach to wait to see how the economy in U.S., any financial problem happen in U.S., and what is the impact on the Chinese economy, and then they will launch out the policy accordingly. So I think for example, even we talk about the property market, there's a huge argument in China whether should they to support the property market. Some people believe that the property sector is too important. If you want to boost up the overall economy, you can't ignore the property market. But for others, they will think that it's a time to make the property market slow down. Even though we may get hurt for short term, but it's a long term benefit for the economy to improve structurally. So there's a huge argument. So that's why I think up to this moment we still can't see any large scale stimulus policy in China.
So these measures that they're talking about on the property market, we had this 16-point plan, didn't we, in November, which didn't really work. It hasn't boosted the property market. Now they're talking about a new package of measures, lowering agent commissions on transactions, relaxing some of the restrictions for residential purchases. Is this going to boost the economy?
I think if you allow some speculation, I think it will. Because right now they only allow one person to buy one property, but that's not going to work because the oversupply situation is very serious. According to some measure, the housing market is something like 20% oversupply, 20% oversupply. So you really need some people to buy 2 flats for each person to really soak up this excess demand. Even though they don't rent it out, at least it's the money. Well, it will help the developers, and they will be able to repay their loans, and then the society will not suffer their loan defaults.
Yeah, I agree with Francis, but I just worry that if we open the box and let the monster to come out, it's difficult to control. I mean, if we allow some speculation, but magnitude of the speculation, so it takes years to control the property market slowdown. If in this case we boost up again, then it's waste our work for the past few years. So it's really challenging for the government. But anyway, I think for even though we can see some large-scale stimulus policy, we still think there will be a series of measures to come out in coming 1 to 2 months.
But has confidence now been damaged in the property market? I mean, if you go back, 2 or 3 years, people were pretty confident that their home was going to go up in value, wasn't it? And that's why they bought second and third properties. Has that froth now been blown off the market and damaged people's confidence to the extent that they're no longer sure that the value of their house is going to go up, so therefore they're more cautious?
Yeah, definitely. I think that the myth that the property prices will go up forever has been broken. I think a lot of the speculators get their fingers burned, and
yes.
and of course the developers have a dilemma. If you cut prices, and then the homeowners that bought the properties at higher prices will ask for a discount.
It's always happened in China.
That will be difficult to handle.
Well, here's another problem then. Chinese exports have slumped in May. They shrank 7.5% from a year earlier, and that compares to 8.5% growth back in April. Economists had expected a 0.4% drop. Now, this is also a problem, isn't it, for China? Because if the consumer isn't spending, and now exports are starting to tail off as well, what's left to help the Chinese economy grow?
I think for me, for the export is less important because for export is other country buying your product. So everyone know that U.S., Europe, especially in the second half of this year, their economy will slow down for maybe recession as well. For example, Germany. So export should not be our focus. But I will say investment and consumption will be the key. So that's why the China government will try to boost up the consumption, especially property, auto cars as well. So I think just take for the export, I think it should not be the big problem. But of course that.
But imports are down as well.
Yeah. This is. I will say try to boost up the consumption should be also helpful for the import as well.
Well, for China, actually, fixed asset investment account for a majority of the growth in the first 20 years since opening up. And but the problem is after so much investment so much money has come into China, overseas investment have slowed very noticeably, especially after this 3 years of COVID lockdown. And government spending, building for infrastructure, I think you have reached a point of negative return. You look at the high-speed railway, except for 2 or 3 lines like Beijing to Shanghai and Beijing to Shenzhen, just about every other high-speed rail line is losing money. So what you get is negative return. You don't get any really payback at all. So there's a limit on what the government can do. And of course, what is left according to economists is really just to give people money to spend, like what Hong Kong did with the spending voucher. But it seems that the Chinese government is not ready to do that yet. So I think we will have to follow what Chairman Xi said. You have to eat bitterness. You have to suffer in silence.
And I think it also related to what we just mentioned, the property market, because for the local government, their revenue usually a big part is coming from the land sales. So they just have a physical deficit in the local government points of view. So it's a little bit difficult to spend a lot on the infrastructure. But anyway, if we are according to the government objective, this year their physical deficit is talking about 3%, which is 0.2% percentage point higher than last year. So we still think that, especially for second half of this year, the infrastructure or the fixed asset investment will increase. For the whole 2023, we are looking for around 5 to 6% growth for the fixed asset investment. So there's still some support on the infrastructure.
But this borrowing has left local governments in quite a big hole, hasn't it? It looks like, I mean, if you believe S&P Global Ratings, and why shouldn't you, they say there's about $6.5 trillion worth of debt in these local government financing vehicles. So presumably now this constrains their ability to go and borrow more and boost their local economies.
But if you don't do it, you just can't boost up the economy. So it's just a matter of what you choose the priority to do it.
And is it a worry, the size of this debt? It seems to be being focused on a little bit more, even to the extent that we had Beijing saying it's not a problem. So as soon as a central government says anything's not a problem, you need to start thinking about it normally, because it probably is. Is this the time where investors are going to start focusing more on the size of this debt, do you think?
Put it this way, I think the worst of the China GDP is over, but just the recovery speed is less positive as we think. For example, for this year, we're looking for the 5.5% above for the China GDP growth. So compared with other countries, it's not really so bad, but just less positive as we think, yeah.
Is China's stalling growth, which is sort of disinflationary, isn't it? I won't say deflationary, but certainly disinflationary in that there's just no inflation. Is that going to get exported around the world and bring inflation down overseas as well?
I doubt it, because in Europe and America, I think the inflation was first caused by the energy costs.
Yes.
Which definitely is,
and the improvement of the supply chain,
and of course the food supply exacerbated by the Ukraine war. So it is difficult for these two big items to fall noticeably in the near future, actually. Especially in the OPEC started to cut production again, so you have energy costs going up again. So what you hope is that the grain prices fall, so the food prices can fall, and then America and Europe will experience lower inflation. But still, nobody expects inflation to fall to 2%. This year.
Yes. Yes. And for China, inflation, for example, CPI, even though the latest number is 0.1, I agree that there's disinflation. But according to our expectation for the coming 6 months, the CPI data will bounce back. For 2023 as a whole, is around 1.5, 1.8. So I don't think there's disinflation or deflation, but just a very low inflation number. That usually is good for China and for the economy.
We're going to find out today, aren't we, with the inflation data, see exactly what it is.
Yeah.
But is this fall in exports a sort of a warning for the state of the global economy? Because we saw those revised figures from the Eurozone. The Eurozone's in a technical recession now, and the jobless claims in the US hit the highest since October 2021. Are there warning signals about the global economy?
Yeah, I think especially for Europe, I think no doubt that Europe is entering into a mild recession.
Yes.
I think US has done a little bit better.
Yes.
I think the employment situation is still quite good in America, and the stock markets are also doing quite well. So I think they are seeing growth in the big techs because of this AI, and I think the technology stocks is actually helping the American economy to emerge from recession. But in Europe, I think it's a more traditional economy, and I think high inflation, high interest rate is really cutting into growth. So, and it will hurt the consumption as well.
I agree. Actually, we just announced our second half economic outlook yesterday, and we believe that the recession of U.S. will delay to next year. So it's delayed, but not avoid. But anyway, for the coming 3 to 6 months, supported by the employment market that's still quite good, and also the investment market, the recession can be delayed.
So what's happened to the US recession? Because the yield curve has been inverted for a year now. And you remember back a year ago when it first inverted, everyone was screaming, recession, recession, it means a recession's coming. But no sign of the recession yet.
I think that the yield curve is a very good measure for the economic situation. But the problem is the timing of recession. They can come out after the inverted yield curve after 6 months or more than 18 months. So even though we expect maybe the early next year we will have the recession in U.S., still match with the past record for the inverted yield curve. So I still think that inverted yield curve is a good indicator for investors. But just don't think that once we have the inverted yield curve and then the economy will be recession next week and then the stock market will go down. It's just not the case.
As easy as that.
Yes.
I think the U.S. economy is much more resilient than the economists have been predicted. I think especially Americans are still spending. Even though rents have gone up, they still have a little money to spend. I think the spending from consumers really has kept the economy growing in America. And I think the economists will really have to redo their numbers. I think they missed this one this year.
Some analysts say that the inverted yield curve is not enough. What has to happen is it inverts, then it needs to uninvert, and the Fed needs to start cutting rates. That's when you'll see the recession. But there's no sign of the Fed may pause this month, but I don't think there's much sign of them cutting rates, is there yet?
Yeah, you are right. According to our study, if we focus on the inverted yield curve, usually they are inverted and then back to normal, and then we will see the recession. So I agree the first part. That's why we think that for coming few months, maybe the recession can be delayed. But whether including the Fed fund rate movement, we did not include in our analysis, so I can't comment on this. But anyway, our base case scenario will be recession in the early next year.
So what about markets? The S&P 500 is now in a new bull market, up 20% from its October low. It's at the highest level of the year. Despite all these inflation fears, despite recession fears, despite the Fed raising rates, 12 months in a row now, 12 times in a row, right. We're in a bull market. What do you make of that?
I think that shows how useless economists are and how poor the doomsday soothsayers how wrong they can be. I think it's just that the human behavior and the economy is really unpredictable. I don't think you can just make some prediction based on some figures. I think people can act something very differently from what people think.
I try to explain. First of all, the economic situation in U.S. is relatively resilient or better than our previous forecast. That's the first one. And secondly, for the debt ceiling negotiation is over, and now the market is looking for maybe maximum 1 or 2 times interest rate hike. So we are near the end of interest rate hike cycle. And I want to point out that even though we think the U.S. stock market is very strong, but they are leading by the tech sectors and also by what we call Fantastic Seven. There's 7 stocks which are accounting more than half of the market cap. For example, those big tech names, they are driving the market. If we focus on small and mid caps, for example, Russell 2000 index, that's not really so good. So, for example, if we are excluding the Fantastic Seven, S&P 500 actually it's just a okay situation. It's not really going up for 5%, 10%. It's not that case. So a little bit distracted by those Fantastic Seven stocks.
But is that starting to change? Because we're seeing now the Russell 2000, the last few days, it's started to outperform, hasn't it? I think it's up about 7% this month in June. So is that a sign that maybe people are going to switch out of these tech stocks, which simply isn't sustainable, is it? You can't have just 7 stocks worth half the market cap.
Yeah, they got far too much, especially NVIDIA is over 400, increased by more than double this year. So it's really way overboard. It's time to take profit.
Well, what about the tech shares here on the mainland? The Chinex has fallen to a 3-year low.
No.
So it's and I think that's certainly in a bear market. We've seen pretty poor performance, haven't we, overall in Hong Kong and mainland China, despite that big bounce we had last week. What's your assessment of where we are?
I think the government have to really keep their hands off the big techs. Ever since 2021, they've been hitting big techs with a big stick. I think now is the really right time to back off. Let them make some money. Let them do some hiring. They are good for the economy.
I agree that the regulatory environment is really tough and it hurt the business sentiment or the investment sentiment. But I don't think that they will change it in foreseeable future. But anyway, it's really disappointed for China tech company for the performance. Yeah.
Does that mean that if you're a foreign investor and you want to invest in tech in Asia, China's not really the market for you? You need to look at maybe Japan, Taiwan, South Korea, India, but not China? Is that in effect what foreign investors are doing?
I think for the brave one, I think it is time to buy when they're at the bottom. I think right
Do you think
now,
they are?
Yeah, they are trading at maybe 10 or 15 times the earnings. They are much lower than the big techs in other in other countries. And I think now is a good time to buy. I think you cannot stay low forever.
Yeah, I think so. I understand that for foreign investors, they get hurt on Chinese tech company. I understand, but just don't. I also think that because market focus is AI, and you can find AI in U.S. stocks, for example, Nvidia, something like that. But for China, it's not really so related. So they will try to choose the U.S. tech stock is understand, but in terms of valuation, I think maybe it's time to gradually to move to cut down your exposure on U.S. tech and gradually accumulate your exposure on China tech company. Because for Tencent is around $320. I think the PE ratio is just 13 or 14 is reasonable, so I won't be too bearish in this type of price level.
But what some investors have said to me is that foreign investors, they've said it's not enough that these stocks are cheap. We need some sort of catalyst that's going to get us to go sort of back into the market. What could that catalyst be?
Well, I think the government need to do something. Like say, I think we're still waiting for the settlement for Alibaba for their so-called violations. I think if they announce that and then they close all the investigations on this and anti-monopoly acts and things like that, I think investors could return.
Yeah, for me as a fundamental analyst, I would say the catalyst for long-term growth is always the corporate earnings. And for me, for the past 2 quarters, Tencent earnings is above the market expectation. So the catalyst has already happened. And if you want to price it at a cheap level, for example, last week, the Hang Seng Index dropped to 18,000 level. Tencent is around 304 or 5. That's maybe a good time for investment. But I agree that for mid to short term, maybe for China tech company, we will use a range trading policy to buy low, sell high to capture the short term opportunity.
So what about here in Hong Kong? Do you see a turning point for the Hang Seng Index and Hong Kong stocks? Because it was a dreadful May, wasn't it? The month was awful.
Well, I think June we already seen improvement, even though it's a small improvement. But still, the big investors, the money has not returned. We have very low turnover.
Yeah, that's
less
a
than
key
$100
point.
billion.
That's a worry, isn't it?
That's a worry.
Yes.
So we still need more money to buy into the market.
Yeah, without enough the transaction purchasing power is difficult for the Hang Seng Index to have a mid-term, long-term rally. So yesterday we announced our target for this year is 22,100, but for me it's a little bit optimistic. So let's see whether in the coming 6 months Hang Seng Index can hit our target.
It was quite a technical rebound, really, wasn't it? Because it hit sort of key levels. The RSI dropped below 30, which is often a buy signal. So sort of people jumped in then. But I get the feeling that if this is going to work, we need a sustainable rebound, not just a one-day rally and then things stay where they are. Are you seeing any signs of that at all?
I think we need to see improvement in China economic situation or a large-scale stimulus policy to change the investor mindset, and then they use their money to buy, and then we can have the purchasing power to boost up the index. But in this moment, we still can't see it.
Well, thank you both very much. A fascinating discussion this morning. Have a great weekend as well. You heard Kenny Wen, who's Head of Investment Strategy at KGI Asia, and Francis Lun, who is the CEO of GEO Securities.
Peter Lewis's Money Talk.
I'm joined now by Mike Gibbs-Harris, who is Director of MGH Asset Management down in Wellington in New Zealand. Very good morning to you, Mike. Good evening to you.
Well, actually, good afternoon here, but good morning to you, Peter.
Thank you very much. Let me start actually by looking over the Tasman Sea at Australia. We had this surprise rate hike, didn't we? One of two central banks, actually, along with the Bank of Canada, who surprised the markets with rate hikes. I get the impression that the Reserve Bank of Australia is caught in a bit of a hole at the moment, and it really doesn't quite know how to climb out of it, because it's worried about inflation, but at the same time the economy is clearly slowing.
Yes, well, I think for both central banks, both in Canada and in Australia, and probably for other ones throughout the world, if their main aim is to bring down inflation, well, it's not coming down at the moment. And so, or at least it's not coming down as fast as people wanted. So they're being forced, I think, to increase rates or to certainly not bring down rates as fast as people expect in order to go and meet their prime need of trying to reduce inflation.
Do you see signs that in some places inflation could be coming down? I mean, we're seeing signs of it in the Eurozone, aren't we? Out here, we've had inflation data from places like the Philippines and Thailand, which was a lot lower than expected. Are there any signs at all that central banks are getting to grips with inflation, and these sort of fairly persistent rate rises that we've seen over the last year are now starting to affect the jobs market and bring down inflation?
I think they're definitely bringing down inflation, but they're not bringing it down as fast as people wanted. And the economy has had a pretty good head of steam coming out of COVID, partly because the US just had such a huge fiscal stimulus. So if people want inflation to get down to 2 or 3%, then they're probably going to have to either live with higher interest rates for longer, or interest rates are going to keep on having to go up. Now, there are places, as you point out, particularly in Asia, China being an obvious example, where inflation does appear to be under control. But in the developed world, I don't think it is the case.
So what does this mean then? I mean, does this mean that the Fed has to keep on raising rates? Because that 2% target, it seems almost impossible at the moment to achieve. Is that maybe the problem, that, you know, this 2% target rate now is unrealistic?
Well, I think it's unrealistic if you're supposed to go and keep unemployment at a minimum. I think that, I mean, this certainly has been a shock. I think central banks are shocked by how high inflation went. And you can put that down partly to supply chains, you can put it down to the Ukraine war, but you can also put it down to a large degree of fiscal support during COVID. Now, how they get out of this, well, there's a couple of ways. You can either have it fiscally or you can have it through monetary policy. And the politicians generally don't want to go and put in a big tightening when people are still obviously under huge budget pressure. Or you can have it slowly through monetary tightening.
So if we look at Australia again, I mean, the economy there, it's slowed to the slowest pace since the fourth quarter of 2021. So over in Australia, it does look like these rate hikes are having an impact, doesn't it?
Well, I think they are everywhere. I mean, people are looking for GMP growth of about 1.5% to 2% this year in Australia. I mean, that's going to be slowing, but at the same time, inflation's going to be slowing. So that's always been the trade-off, really, in financial markets or in economies.
Tell me a bit about New Zealand. We don't talk that often about New Zealand on the show, but I think it's fair to say that the Reserve Bank of New Zealand has been one of the most aggressive central banks in the whole world, hasn't it, in raising interest rates?
Yes, except that they actually caused a surprise by doing the opposite of after their last rate rise. They said that they didn't think that there'd be any more, and that weakened the currency and basically helped the bond market. They essentially came out and said, well, we think we've done enough. Whether or not that's the case, I suspect that even though central banks aren't supposed to be political, they all are, and we have an election here in New Zealand in October, and I think that they just wanted to be perceived as being neutral ahead of that election.
And how is the economy doing?
The economy is actually doing worse than Australia. I mean, retail sales are weak. It's partly because the recovery from COVID has been more muted here. We haven't had the amount of tourists that we hoped for. We're also dependent upon China opening up, just as Australia is, and so it's struggling, I would say.
And is it
the economy?
Is it dependent upon China? We're seeing obviously clear signs of the rebound in the mainland not being as strong as people were hoping at the beginning of the year. Is that having an impact on New Zealand?
I think it's having a little bit. The property market's been weak. It was very, very strong in COVID, and now there's a hangover from that. And so that's also crimping consumer sentiment, crimping demand. So whereas in Australia retail sales are pretty much flat, in New Zealand they're down about 4% year on year.
Mm. So what does this all...
So,
sorry, Mike, carry on.
So the consumer side here in New Zealand is definitely suffering.
What does this all mean, do you think, for markets? We've been talking about the yield curve, the US yield curve, a little bit earlier on. It's been inverted now for over a year, and when it first inverted, people were screaming recession, saying this is a warning signal of a recession. But certainly in the US, anyway, not much sign of a recession, is there?
Not yet, but I think there's one out there, and everything you see, it's all leading indicators, and it's getting less strong each time. But I think if you've got unemployment extremely low, you don't have the problems with forced sales of houses in the US in the way that you do elsewhere because of the way in which they structure their mortgage market. So I think as long as unemployment stays very low in the US, it'll probably hold on. It won't be as strong as people want. But at some stage, people are going to run out of their savings, or people are going to stop investing.
And we are seeing signs, aren't we, of the job market slowing? We saw that in the jobless claims numbers yesterday. So the signs are there as well, aren't they? That the froth is coming out of the jobs market.
Yeah, I think things aren't as vibrant as they were, but they're still not very bad. I mean, unemployment's at 3% and a bit in the US. That's probably pretty close to full employment. Most of the estimates are that people have managed to maintain or haven't spent all of their savings, which they had through COVID. But on the other hand, you're seeing people trading down. You're seeing problems in some of the stores, such as the discounters, which sell to the low income people. So it's going to come.
And do you want to make an attempt to predict what the Fed is going to do next week? Lots of people are predicting, well, they don't like to call it a pause now, do they? They want to call it a skip, which sort of implies nothing this month, but then rates are going to carry on rising in July. I'm
not sure. I think that people have been looking for cuts by the Federal Reserve. I think this year people were talking about it at the beginning of the year. It's not going to come this year. It might come next year if we're lucky. Next week, well, it's not going to go down. It probably, I think they'll pause and then they'll just have a look. And to be fair to them, they've always said that they'd be data driven, and unless something really out of the extraordinary comes from the economic figures over the next week, I think that they'll probably pause and say that we will continue to be data-driven.
And what do you make of the equity markets? The S&P 500 is at the highest point of the year now. It's back in a bull market. It's risen 20% from its October low, but very much dominated by these small number of tech stocks.
Yeah, there's been a little bit of a pickup in the smaller caps, partly because the banks and the oils have done a bit better over the last week, but really it's just been about 8 stocks. And if you exclude those, underneath things don't look good, but you can't really argue with a market going up. On the other hand, those 8 stocks aren't looking particularly cheap, and I think that there's a lot of good news already in the price.
If you wanted to play the tech rally, is there any way you can do that in your markets out there or over in Australia?
There's such small stocks, with a couple of exceptions, that it's probably not really worth it. And if you really want to have tech stocks, then you're better off being in the US or being in some of the hardware manufacturers in Asia.
Well, Mike, it's always good to talk to you. Thank you very much indeed.
Okay. Yeah, well, thanks, Peter. Nice to have a chat with you again.
That's Mike Gibbs-Harris, who is Director of MGH Asset Management over in Wellington, New Zealand. Thanks to my guests this morning, and thanks to you for listening today and this week. If you want to get more details on some of the stories we've discussed this morning, please go to my website, peterlewismoneytalk.substack.com, and have a read of my daily newsletter. I'll be back on Monday, when I'll be joined by Alex Wong, Director at Alex KY Wong Asset Management, and Carlos Casanova, who is Senior Asia Economist at UBP. In providing a view from mainland China will be Shanghai-based independent economist Andy Scher. Have a great weekend.
Money Talk